let's keep rolling. So we're going to head now to the deep dive topic. So it took me a while to realize this, but building yourself a solid network of contacts is, I think, a superpower. The value of a well-maintained network compounds over time. The more it grows, the more value it creates, helping it grow further. And a recent example of this came last year, 9 months or so ago, when a mutual contact introduced me to today's guest speaker, Fleur. It was immediately obvious to me that as a twice exited founder, now advisor and exec with 20 plus years industry experience working on M&A transactions ranging from the millions to billions, Fleur was going to add incredible value to my network. Fairly quickly, we began exploring opportunities and collaborating, and I was delighted when Fleur accepted my invitation to come and present her talk today, titled Understanding Critical Elements of Due Diligence to Enhance Business Valuation and Investor Appeal. So Fleur, the stage is yours.
Thank you. Right, okay, well, Graham introduced me quite well, what gives me the right to yap on about this stuff. I've exited 2 businesses myself, having raised capital throughout both as well. My latest business being an M&A advisory firm. So I've got quite a lot of experience sitting both sides of the table, and I think one of the core things that comes about when we're thinking about generating value and key things to think about within the diligence process, it's really about anticipating what the buyer wants to see. Storytelling effectively and anticipating what the buyer is looking for is a key part of the diligence process. You can read my profile on LinkedIn. I shan't yap on about myself too much. This is about you and what we can deliver for you. So, critical elements of due diligence to enhance business appeal. The way you present your business can literally mean the difference between getting the valuation you want or raising the capital you want and not. We, between us, Gary and George and perhaps Sophie as well, have probably seen quite a few deals fail, especially at the lower end of the market and especially in the recent sort of economic climate, than succeed. So I think one of the key learnings is that being prepared is really, really essential. Understanding and knowing what an investor is looking for, whether it be a minorities or growth investment or whether it be a buyout. So yeah, we'll look at the key elements of these so that you're front foot forward, and hopefully not one of the deals that has to stall or pause if ever you get to that point, because it's not fun and a lot of time and energy goes into it. I think one of the first questions I generally ask when I'm speaking to founders who have asked me to help them prepare for exit is sort of asking themselves questions before you even start the process. First one being, why now? What is it that you need or want to get out of this process? Because that really, really does impact the structure of the deal and the type of exit, if it is an exit or fundraise that you're looking for. There are loads of different motivations that we come across. I mean, some people are looking for a straight exit with no earnout, i.e. a full buyout, and it's because they've come to the end of their career, or been working with their company for a long time, or there's been a significant personal event that's changed their perspective. To give you an example, why did I sell my business? It was thriving. We'd set up offices in New York, Boston, London, Paris. We're just setting one up in Dubai. And actually, number one, I was a bit tired and a bit lonely. No matter how many advisors I had around me, I was still sort of the sole and significant shareholder. And you get a bit done with that especially after things like Brexit, and which was the starter, followed by COVID, followed by Liz Truss's madness, followed by followed by the Ukraine war, it just feels like hit after hit after hit, and I was sort of done, actually. And then a significant life event sort of that had me thinking, right, okay, tell you what, I'm just going to pass the reins on to somebody else. Let's let the company, the brand, the legacy of it go to a good home. So motivation is a really key important factor, and that helps inform the exit type. If you do want a sort of full buyout, trade buyouts are really good, or if you're fundraising, as Andrea said, minority stakes. But they're also about timing. If not now, when? Depending on your motivation, how quickly do you want to exit? And these are questions. You'll find I'm asking a lot of questions in this, actually, because these are sort of food for thought when considering due diligence and an exit process. And then more things to consider before you start the process. You got to the point you decide, yes, I do want to exit the business. I'm looking actually for a trade buyout, because then I can exit within 18 months. I'm not looking to recapitalize after 2 years, etc. What do I need to consider? Well, the first one is to keep trading. Deal distraction is a real thing. And I think it's something that, as founder owners, people often under consider, stroke don't consider, in part of the preparation for deal doing. Therefore, having the right infrastructure in place and divesting responsibility for instance, pipeline activity is going to be really important, because aside from key man dependency, you're not going to have the bandwidth as a founder owner to do everything. So if you're the main sales engine for your business, then actually divesting that and creating an infrastructure around you so that normal business operations can continue is essential. One of those things, which I'll come to in a minute, is having a really bloody good CFO in place. Somebody who knows the numbers and can defend your position whilst you're telling the story, actually. And as I say, delivery against targets along the long, sometimes DD process. My second exit was to a PLC. That is a bloody nightmare diligence process. They want to see receipts from 8 years ago in Starbucks in November 11:30 sort of thing. So those things are really real. And then, so you need to keep trading, also being prepared, and I'll talk to you about what you need to prepare, but essentially what the preparation needed to enhance your value really is codifying properly the proposition and procedures. Because that's what you're doing when you're telling your story and you're delivering against targets whilst you're doing multiple story tells. You need to have codified what your proposition is. Creating a data room is one of them, being as prepared as you can. Having coffee chats ahead of a process. There's nothing like a good rumor about a process about to start that gets people interested in your asset and enhancing value. And time. Make sure that you've got adequate time to deal with the process. So, and who do you get to help you? We talked about infrastructure and setting that up. Are you, and again, questions, do you want to run the process yourself? Is it a small process or a large process? Can you do it yourself? Unlikely. Corporate finance houses or independent consultants like Gary and George would be people to help you along the way. If it's a sort of smaller transaction. For large transactions, you might want a larger corporate finance house. Asking peer networks, as Graham mentioned, as to who to get to help you in processes is a really good starting point. And this all, trust me, does contribute to creating value and maximizing valuation. Also, have you factored in these sort of fees? Because if, as I say, the first thing you probably want to do alongside an advisor is get a CFO in. fractional or other, to help with these anticipated sort of costs and things. So constructing your deal team is really essential. People who are experienced in transactions is obviously preferential, and people with good reputation. Why? Because expert consultants align the goals of the sellers with those of the investors and connect the two. You're good at writing, as a founder owner, generally you're good at writing the story, telling the story of your business. The why do you exist? What do you want to achieve? Why would you be a good outfit for a buyer? And then the deal team around you will help connect the dots aligned with finance, commercials, tax, legal, etc. They also help you anticipate what the buyer wants to see and hear. You know, I've seen hundreds of transactions on the buy side, and not many people have, especially if you've been running a business. So what are the key components of the DD, and how will they enhance your value? How will preparing a data room, which if people don't know what a data room is on the call, it's a locked folder structure, an online digital room that contains folders mapped to, broadly speaking, your financials and tax, your legals, so your compliance, your insurances, any sort of licenses and things that you might need in place for basic business operations, your commercial folder, which includes your sales and marketing efficiencies, your growth ambitions, your pipeline, your key clients list, those types of things. Your operations folder, this includes your team and your HR, how you're operating the business, what are the processes. If we're thinking about, there's some developers and things on the call, if you're thinking about the key unique selling points that are involved in the operating mechanics of the business, that's sort of what you'd pop in there. Tech and IP. Tech has always been very important. You know, how's your tech stack looking? Are all your compliances in place for that, for data management and things? But IP tends to sort of sit as a really, really key component in business valuation these days. So getting an IP lawyer on board as early as possible, like Potter Clarkson, will really enhance your valuation, because it'll allow you, within your investment memorandum, i.e. the book that you send out, your seller's book, they will help you identify what your unique selling points are and codify those into an IP proposition, which helps enhance your value. And the more tech IP you have, tech-based IP you have in a business, generally the higher the valuation. And then digital and AI, and I put that in as a separate component, because one of the key questions that's being asked in diligence at the moment is defensibility against the AI proposition, and therefore having separate folders that tackle how you're dealing with digital, what your digital roadmap looks like, and how importantly your commercial proposition is impacted, you're defending against new technology evolution, is really, really important. And as I say, having all these in place ahead of starting a process and thinking about these themes will really enhance your valuation, because then you can brief your CFO and your commercial forecaster to be writing in these assumptions and this thinking. I mentioned highlighting key strengths and USPs. You're still telling a story backed with data, and any investor will be buying into both. So again, the 4 key themes that we tend to observe when you're telling the story are an awareness of the competition, so market mapping, who else is in the space, how much is the space growing, at what rate per annum, what market share do you have now, and how are you going to grow that over the next sort of 3 to 5 years is really super important. So being able to articulate your unique value in the context of the marketplace is what you're considering there, in anticipation of some, tough DD questions around your competitor's space, actually. What's the growth potential? How do you evidence this? It's a bit of a sort of follow-on from the market space, but are there any adjacencies as well? Adjacent products, adjacent geos? Are there adjacent service lines that you can go into? How might you grow your proposition? Oh, crumbs! Fire alarm. Okay, be safe. Yes, because actually, you can forecast sort of organic growth, but there's also additional growth potential and growth potential through M&A activity. Of course, that might be within your roadmap. Management and talent pipeline. Not all businesses are tech businesses. The reason that investors like tech businesses is because they are because the talent doesn't walk out the door at 5 p.m. So they tend to be sort of low risk. That said, there is a recognition, of course, that to run good businesses, you need good people. And so actually sort of highlighting the founders and key personnel within your business without leaning in too much that there's key man dependency for survival of your business is quite a fine balance to pull off. And then the strategy, how are you getting from A to B? You've got sort of the now, and you're telling a story about how you've got to where you are now, and you're telling a story about where you want to get to. Where's the thinking around getting from that point A to point B that is defensible, that an investor is going to buy into? And as I say, it's a story backed by data. So this is all preparation essentially to enhance value. What impact does this preparation have? It demonstrates operational efficiency and scalability. How have you handled growth, and how do you look to handle growth in the future? Can you cope with investment? Andreas raised cash capital, and he will have been asked many questions around what he's going to use the money for. So I have a really good idea and a plan as to what you're going to use it for, and deliver against that, of course, because any investor is likely to join the board and will be asking you questions around your own KPIs that you set. Isn't that right, Andreas?
Yeah, certainly. And regular meetings, lunches are maybe the funner side, but yes, absolutely.
That's it. Financials, financial health and sustainable growth, strong financial management and a clear path to profitability and growth is super, super essential, whether it's a seed round or whether you're in a sort of Series B. Everybody needs to be able to show this. And then tech and innovation, as I say, technological infrastructure. I didn't just put that in because Graham's hosting the event. It's definitely these questions are really being asked. So showcasing future readiness through the lens of technology is super important, and that will get you towards the valuation you want. Sophie mentioned a valuation calculator tool earlier in the call. Well, actually, the value of a business is only what people are going to pay for it. So we can set our EBIT valuations based on our historical profitability, but ultimately telling the story and being able to defend that with data from multiple sources is what's going to get you your exit valuation. So I feel like I've been talking for a long time, to bullet points and takeaways. The one slide actually that's of value. Just think about why you want to exit, who you want to exit to, when, what you're going to do with the money. Build your plan. Definitely get advisors if needed. People who don't know, and Sophie, correct me if I'm using the wrong terminology, but the cost of deal doing is a special expense. So is it special? I can't remember the phrase. But
exceptional cost.
There we go. So yeah, so that's an exceptional expense. So it's not going to impact your EBIT. Don't stall a deal because you think it might impact your valuation. That is not a future expense. So it's get the right advisors in, I would say. Data room prep, really helpful. Now you can prepare all you want. There will always be more questions asked. You may think that you've anticipated everything and you've uploaded every document, and there are some brilliant tools that can retrieve documents from your servers that you might need for data rooms and deal doing, but there will always be more questions asked. However, better to be front foot forward. Know your numbers. For every I mean, you should anyway, right? As a founder or CEO or anybody with a significant position within a company, but knowing your numbers is never more important than when you're deal doing. Revenue, profit, projections, everything like that, you should be able to rattle them off. A good IM, that's the story bit. You're selling the dream. You're selling your dream, and you're still delivering on your dream whilst you're selling it. And in order for a buyer to buy into it, it's got to be a good story. And then network. And ask your network. Rumors can actually be a good thing. Getting a few murmurings out there before an official process launches can be a good thing. Not always, but it can be a good thing. But yes, preparing for DD will maximize business valuation through the process of you looking at all these things ahead of being asked, and they can significantly enhance your investor appeal. So in terms of the nitty-gritty as to specifically what you do, that's business and case specific, of course, but having these things in mind before you start a process should help.